Welcome, everyone. Last year, Phil and I tried something for the first time. We tried to come up with some market surprises. We'll go through how we did last year and take a shot at that once again for 2025. Phil, we talked about it a year ago, but I know for many in the investment world, and I know for you and I, one of our favorite and most anticipated published pieces every year was Byron Wein's 10 Surprises. Byron passed away at the end of 2023, and we were inspired last year to take a shot at that, coming up with a few less, but trying to push ourselves and test the limits of our thinking to think beyond just what our best thinking was and our views of the world and what the consensus was to identify, as Byron often did in really insightful ways, finding ideas that were maybe outside of market consensus that could end up coming fulfilled in a given year. We'll go through our surprises from last year really quickly, and then go to our surprises for 2025. It turns out we actually did an okay job in our first shot at this, and maybe if anything, we've got to take a closer look at these surprises as we go through our overall outlook. Phil, you in particular did a really nice job with your surprises. So let's start out there. We'll go in order of how we went through them. I was first. And my first surprise was a Fed hike in 2024. And I will give myself partial credit for this one. I think the basis for that thinking, if you go back a year, the market was pricing in upwards of 6 rate cuts in 2024. We thought the economy would stay relatively strong. It would be resilient. The labor market would remain robust. And inflation would be a bit more sticky, and that we wouldn't see anywhere near the cuts that were anticipated, certainly not with the timing. Those cuts were anticipated to come very early on in 2024. I think we went a little bit more aggressive than we wanted to with a full-fledged rate hike, but the path of that was certainly similar to how we thought it might play out, and in particular, risk assets, equity assets in the U.S. Really outperformed as a result of that change in thinking, as it took a lot longer to see those rate cuts, and the economy did show that resiliency that we were expecting. So didn't get it fully right, but we'll get partial credit for the first one. Phil, I'll let you take the second one. The second one was European vacation, U.S. dollar parity. How did we do there?
Yeah, I have to say this whole exercise this last year I quite enjoyed. I think in many reasons I felt we did a great job on our surprises, and I definitely took the advice on this one, as I did vacation in Europe over the summer, and the euro wasn't as cheap I was hoping, but by the end of the year we got pretty close to parity, and I think as we look to this year, if the Fed holds rates steady, and you see a couple more cuts from the ECB. You might see, dollar moving through parity, and some real weakness in the euro, which is not unprecedented, but it's very rare that we've seen in the last 25 years of kind of the European experiment.
Great, well done there. The third one I put forward, it was a global grand bargain, and this would have taken a big surprise. The market consensus. The economic narrative is about deglobalization. It's about conflicts between countries, protectionism, the ongoing challenges and trade war between the U.S. and China. And so it would have been a big surprise if we got what we describe here as a global grand bargain, peace in some of the hot wars that we've seen play out tragically across the world, some sort of trade agreements in place. We certainly didn't get that in 2024. I think 2024 was a continuation of that overall narrative and consensus of having a lot more trouble working together across countries around the world. Now, we've got a new administration in place in the U.S. There's a mandate to do some things differently, some of which means more protectionism, like rising tariffs. Some of which could mean more cooperation, which often those tariffs are a tool for negotiation rather than an outright an outright implementation to make costs go up and make trade more challenging. So we'll see how that plays out. I don't think we'll be offering this one as a surprise again with the new policies that we see in place. But we got to test ourselves, and we certainly didn't get that one. Phil, the next one was U.S. single party control. You put this one forward, and it absolutely nailed it in November.
Yeah, I think I've been wondering for 30 years what use my political science degree was, and maybe it was for this prediction here. But I think as we look back at the start of last year, markets were certainly pricing in, essentially continued gridlock from Congress and DC. And for the most part, markets tend to like, split control of government, and you have a narrow range of outcomes when you see that. And I think one of the things, as you looked at some of the potential races that frankly could have gone either way, single party control, depending on kind of certain outcomes, and we certainly see that. And I think it's fair to say when we look at the policies of the new administration, probably a wider range of outcomes that we'd expect relative to a divided control in DC.
That's great, and I think the outcome of this single party control may be part of our surprises that we put forward in 2025 and beyond. Our next one was the Center of Innovation pivots to healthcare. And this was mine. The basis for this was that artificial intelligence, the impact of that would be far reaching and hit other sectors beyond tech. We haven't seen that yet. I think there's some undercurrents of things happening in healthcare. If anything, you saw healthcare get slammed in the second half of the year, more because of a new administration and new approaches to healthcare. But I think the case is still here for a lot of innovation in healthcare through AI, through the GLP-1s and all that can be used for. So this one will take longer to play out, but I think as an investment thesis, this can still make a lot of sense, particularly in the private market space where you can be earlier on some of these themes.
I still think that's an interesting one in your defense of longer term thinking about what could have a bigger impact on kind of the economy or spending, GLP-1s or AI. And AI is winning that race, it seems, for now. But you look at some of the kind of advanced studies that are coming out on GLP-1s and just how it impacts a wide range of things beyond just kind of weight loss. It's impressive. It's really impressive.
Yeah, it is. But this was more a lesson of how to create these surprises. That if you're going to do an annual surprise, you got to focus on some things that have a real chance to play out in a given year. Yeah. This is more of a 3 to 5 year theme, probably. Still valid, but not in the time frame that we're talking about here.
Well, I think in line with that is the call last year for S&P 6000. I'm not sure if that was a prediction or a surprise, and more just an acknowledgement. This is what the market's expecting. Because there's hugely positive sentiment throughout the year we saw last year. So we tipped over 6,000 this last year. A little bit of preview of some of our thoughts kind of this year, like is another 1,000 points possible? Like maybe. But it's a fair amount of kind of strong momentum really built in the markets last year. And you saw another double digit, another 20% increase from S&P, obviously led by the Mag 7 names.
Yeah, and this one, Phil, you nailed it, but I think this one was particularly out of consensus. If you think about the base case coming into the year of needing 6 Fed cuts to move through a slowdown, that was translating to some pretty tepid expectations for equity returns and for risky assets. If they were going to be positive, they were going to be modestly positive because the response from the economy was enough from that support from the Fed. It was really the strength of the underlying economy, the strength of those Mag 7 companies that really drove it forward in a really impressive way. Phil, let's stick with you. Let's spend a few minutes before we get into the surprises. It'd be great for you to just lay out for everyone what our investment themes are for 2025.
Yeah, and this is an exercise we do every year to both kind of challenge ourselves and think about what are the key drivers maybe for the market for a coming year. And it's an exercise we go through to set kind of a baseline view, and our surprise thoughts that we're always having these discussions kind of are tangential to some of these themes. I think it's interesting just to see how much the narratives can shift throughout the year from the start of the year to the end of the year. And at times it's hard to do this, to say, what are some themes that they consistently apply throughout the course of, a 12-month period. And we did a pretty good job last year with ours, and some of it's a continuation of what we said, prior year. And so as we look at the themes for this year, I think the key ones that we see, artificial intelligence spending. So you think about the CapEx coming out of the Mag 7 names, in terms of just the big ramp up in terms of data center spending and the infrastructure spending you're seeing from those names. And already a little bit of not a question mark, but a hiccup in terms of how markets are expecting that with some of the supposed cost efficiencies associated with DeepSeek. Another big theme of ours, which also a continuation of this last year, is these pockets of euphoria that we're seeing. It's a little meta in terms of how we're thinking about it, no pun intended, but thinking about Mag 7 really rising, continuing to rise, a lot of positive sentiment. It's not a bubble, but it has some of the characteristics that if we see some really outsized growth, it could be a bubble. And also other areas in the market. You look at cryptocurrency, massive growth and kind of an asset level, which does more look like a classic bubble like we maybe have seen over the last 500 years of financial markets. And the last two themes we have are somewhat interconnected and really reflect the pivot we've seen with the new Trump administration in terms of likely U.S. policy, both in regard to trade policy. So thinking about tariffs from the standpoint, not just are tariffs going to be on or off, or is it a negotiating tool, but thinking through the mechanics of tariffs. What does it mean? What's the implementation of it? What are the legal levers that can be used? And just provide some kind of context and information flow to tariff policy. And I think at its core, we're looking at tariffs maybe don't have too big of an inflationary impact as long as you don't impede the flow of goods. And I think that's, or break supply chains. And I think that's always kind of the line that the markets are trying to see when we think about tariffs. And the last is just the context of world affairs. Tim talked about this already a little bit, but what happens in the world, how countries relate to each other, policies around the world really matter. And questions around how we deal with China. We've got some major elections in Germany coming up. The new administration, kind of the pivot in terms of foreign policy that we've seen relative to the previous administration, will have an impact, and that vol and that some of those surprises will start flowing through markets.
That's really helpful. I think that gives us a great foundation to think about what's the base case, what are our expectations, and what are some potential ways that the market could surprise us and pivot off of some of those expectations. So let's get to our surprises. Phil, you came pretty close to running the table last year, so I'm gonna have you kick it off. And just a reminder that these are not our base case views. Phil went through some of the themes that we see happening. We wouldn't suggest that anyone go out and reposition their portfolios on any of these surprises, but you can envision a series of events that could play out, or a singular event that could cause these surprises to manifest themselves and could cause disruption in some of the themes that we see. And that is part of setting these themes. They are the forces that are driving markets, but disruption of these themes is an important thing you have to look at, because that could produce a lot of volatility. So Phil, what's your first surprise for 2025?
Yeah, I felt good about the surprises last year, and we do believe in mean reversion. So this is maybe not a good sign for me this coming year.
I need a little mean reversion after my surprises last year.
It could be an over three this year. And we've been working on this for the last couple of weeks, thinking about what the surprises are. And after yesterday's CPI report, I'm feeling less confident than I did on Monday, as we record this on February 13th. And the surprise that looking for 2025 is seeing 4 cuts from the Fed. Right now, the market is barely pricing in 1 cut. You look at a lot of the statements we've heard from the Fed, where the job market is relatively healthy. There's no need to move quickly. Inflation's clearly sticky to get back to a 2% Fed target. But in the past, there's always been a tolerance to let that kind of average in over time. And I think what would be the surprise is multiple cuts coming, which probably would happen in the back half of the year, and really come from maybe just some cracks in the job market. And this is not a recession call. We've seen 2 years of more than 2 years, really robust job growth in recent years. And job growth is cyclical, and just some slowing of kind of job growth, over the next 6 months is enough to not spook the Fed, but get their attention, where they're going to focus more on unemployment than maintaining kind of a stable inflation rate. And I think that is what you could quickly see market expectations shift from barely one cut to kind of 4 cuts, and you could see 4 meetings in a row with a cut. And some of this ties back to, just thinking about Fed funds relative to CPI. So the 12-month rolling core CPI as of January is 3.3%. The Fed sitting at 4.5%. So we still have a 120 basis point premium Fed funds relative to CPI. Should we see, CPI or inflation roll down to 275, 250, which we're not that far up when you take out a few special items, it's easy to see, if the Fed has a little bit of a catalyst to quickly move to a 375 and 350. So I think one of the things to kind of think about is, how does the market respond to 4 cuts in the back of the year? Could we see, S&P 7,000, could equal weight outperform in that type of market where, in a more robust M&A world where, you see a lot more private equity deals, some of the deregulatory emphasis we've seen from administration benefits the financial sector, maybe see some recovery in industrials. I'm painting a very optimistic, kind of euphoric outcome here, but it certainly would be a surprise relative to kind of what we're seeing today. One thing, Tim, just maybe for you to jump in on, is what's not getting a lot of attention. They talk about kind of 4 cuts or 3 cuts, from the Fed, is just what the Fed does with their balance sheet. We used to talk about this ad nauseum over the last 10 years, and it's just kind of this forgotten aspect. And we're under 7 trillion now in terms of Fed balance sheet. Pre-COVID, it was 4 trillion. Do you have any thoughts of, how the Fed is maybe thinking about their balance sheet and kind of the liquidity aspect of what we could see in terms of how it's impacting markets?
Well, I totally agree with you. It's been forgotten, and all the focus is on what we will see for rate cuts and when they will happen. In the midst of that, quantitative tightening continues, and I think that is the Fed's way of trying to continue to manage inflation by continuing to provide a little bit of a headwind to markets. Now, I think that's been more than offset by an overall flow of liquidity across the globe that has pumped more money into markets, that has superseded anything from quantitative tightening. But I think that is going to be, for this path to play out, the balance sheet will be an important front-end signal. Before we get to a change in expectations and a change in rhetoric, if they're moving off of selling bonds back into the market, if they're going from quantitative tightening to a more neutral approach, that's a signal that they're more worried about the economy and that we may see a bigger change going forward.
Yeah, that's a great point.
And I also think, just as you're painting a rosier scenario from these cuts, a potential sub-surprise here is that with cuts, you'd expect when you get cuts, the market interprets that accommodation as being good for the economy. And it should be. At the same time, there's this phenomenon of good news is bad news with Fed policy. To the extent the Fed does put forth an approach that is cutting more aggressively, the market could engineer that and say, wow, the Fed thinks the economy is in trouble. This is bad news. We could actually see a bit of a drawdown.
No, that's the investor psychology and kind of that invisible hand that flows through markets is always a fascinating aspect of, if they're doing 4 cuts, they must really be worried. What do I not know? What do we not know in terms of what's coming through? And it ties back to, trust and leadership of the Fed, confidence in the Fed. We look at, just some of the Fed's projections that have changed over the last 3 months. They're clearly anticipating some higher levels of inflation. But you look at the historical mandate from the Fed, it tends to be more data-driven as opposed to speculative. And so there's, we've talked about this in our annual letter and some of the discussions we've had with clients is the Fed's a little spooked in terms of how they're thinking about kind of market expectations over this next year. And I think one is a little cheeky, but kind of a prediction within a prediction is if we do see 4 cuts, what's the likelihood that Chairman Powell is renominated? I would say most people would say very unlikely today. His term expires May of 26. But cuts 4 times, maybe a surprise would be he gets a new term. I would
Trump
not
likes
put
lower rates, so that would.
I would not put big dollars on this one, but
Yep.
It's an interesting thought exercise as you think about what happens to the market as you start seeing cuts.
Absolutely. Yeah, I think everyone forgets that Powell was nominated by Trump. It's kind of funny that he can be the scapegoat for Trump, but he can also be the solution if things go.
Yep. Yep.
Well, let me jump in with my second surprise. It relates a little bit to the 2 sides of the coin that we talked about, depending on that policy. I'm going to cheat a little bit here because my surprises did not perform as well last year. So I'm going to give myself a couple outs on this one. I'll call it 1,000 points of light or darkness. I think we will see a 1,000-point move in the S&P 500 over the course of 2025. Now, I think that could go in either direction because of some of the things that we've talked about here. It just feels like we are not going to see that nice, modest, single-digit return that we all want to predict and rarely see from markets. It's really hard to tell which way it would go. But I think we will see a big move. That would be a surprise to markets. The S&P ended the year last year a little below 5,900. It did eclipse 6,000 along the way to nail that prediction for you, Phil. But from those ending values at the end of 2024, that would mean a 17% move in either direction to go up or down 1,000 points. Building on that S&P 6,000 idea that you talked about a year ago, that means we'd be right on the verge of S&P 7,000 in an upside scenario. But on the other side, if activity is slowing down, if a more of a recessionary environment is getting priced in, if the Mag 7 disappoint in some way, if there's a big earnings miss there, or there's another bigger DeepSeek surprise along the way, we could be looking at a 4 handle on the S&P, which I think that would be the bigger surprise of these 2 events. I think there's one of our themes is pockets of euphoria. It's not broad-based euphoria and bubble-like conditions, but I think there is a lot of optimism priced into markets right now. There's optimism about corporate activity, both corporations being able to continue delivering high profits. There's optimism with new policies from the new administration, both that those will promote economic growth, but there'll also be deregulation that could lead to a new wave of M&A activity. And all of those things are coming together to create what I think is a pretty optimistic environment. That optimistic environment could play out and even exceed those expectations to see really strong results, a 3rd straight year of almost 20+% returns. That would be the first time we'd seen that since the late 90s. But that could also disappoint. And if it disappoints, I think there will be a lot of unwinding that has to take place and a lot of fresh thinking about where we go from there. And that could cause markets to reprice pretty significantly.
Yeah, it's interesting just in terms of like how at times strong the market narratives are, but after the fact you realize how seemingly kind of fragile they are, whether it's kind of AI spending or some of the kind of geopolitical dynamics that exist. And you just never know what's the market going to react to, and when it reacts quickly. And plus or minus 1,000 points, it is somewhat of a wild range, but easily could see that. And in some ways, both sides of those, we could see happening in this coming year.
Yeah, and it sounds wild to see that level of move. I think it's well within the range of expectations when you think about portfolio construction. A 17% move up or down is within one standard deviation. And Phil, I wonder if you could spend a minute just thinking about what that means for portfolios, how you build a portfolio to protect against those kind of big move scenarios with what is generally the largest asset allocation in a portfolio, U.S. equities.
Right, and I think this year, spot on is S&P is generally going to be the largest holding for most of our clients, and within that, the Mag 7 is probably the largest holding for most of our clients if you split it out as a single line item in some cases. And kind of the emphasis this year that we've really focused on is kind of a concept of diversification, and it can be somewhat generic, but thinking about having a solid, diversified strategic asset allocation. Stick to your targets and make sure it matches up with your objectives. But also thinking about how does that apply to many different concepts within asset allocation. Do you have a diverse source of pool of liquidity, whether that's to meet private market commitments, manage 1,000-point moves in the S&P to be able to rebalance. Also thinking about within S&P, are there ways to be diversified? Thinking about alternative U.S. large cap exposures that maybe include some value and quality factors, just to diversify that exposure a bit, because the concentration's gotten quite high. And so I think as a whole, more so than other years, really focusing on diversification and kicking the tires on that to check portfolios.
Yeah, absolutely. But I think our first couple of themes here have focused on the U.S. Maybe we'll go to your third surprise, which takes us once again across the pond.
Yeah, I'm going to jump back to Europe, staying away a little bit from which direction kind of European currencies may move. But I think about 10 years ago, a lot of questions came up with the European banking crisis regarding what's the stability of the euro, what's the stability of the eurozone, and does this experiment work? And I think what's interesting is 25 years later, since the inception of the euro, we still call it an experiment. And it can't be an experiment if it's permanent. And at some point, there has to be some sort of change. And we think about just from an economic profile for the eurozone, the GDP growth for the last 2 years relatively weak. So we saw 0.7% GDP growth in 24, 0.4 in 2023. Germany, the largest economy, saw its economy shrink in 2024. So when you have kind of weak economic growth, it tends to really start to stress the system. And as we think about what this means for Europe, those questions of the stability of the eurozone, the stability of the euro, we think will kind of rear up again. Some of this also has political influence. We saw last year, French bond spreads widen out a little bit with essentially a frozen government at points over the course of the summer. We have a German election coming up at the end of February, where we're likely to see the center-right party take power. But the second largest party that we're likely to see is the AfD, which is a far-right party and very much a Eurosceptic political organization. And so across Europe, especially France and Germany, which is really the heart of the EU, there's a rising tide of Euroscepticism building. And I think markets will start to pick up on that and raise some questions of, what's the commitment from the two key governments in Europe to the euro, and how does this start to price in? And I think one interesting aspect of it that makes this a bit of an odd prediction is there's so much bad news priced into kind of economic growth in Europe. Could we see question marks on the EU, but also equities rise at the same standpoint? And so this fits back to thinking about, let's try to be more balanced in our equity exposure, try to be somewhat in line with global benchmarks, which we proxy as ACWI, IMI. We don't want to make too big of a bet over or under, but we could certainly see, some catalysts or some movements to a bigger change coming this next year, depending on the outcomes of some elections. And this is everything from, could Germany kind of reduce what's kind of been called the debt brake there, where they've been limiting fiscal deficits? allowing for greater government spending to help stimulate the economy. Some of this could come through defense spending, depending on, if countries are more aggressively looking to meet their NATO targets. So a lot of big questions we think will come up for Europe that politically is likely to be a very challenging year. But that doesn't always translate to markets. And in the same way, it's probably a challenging economic year. And the correlation of GDP growth and equity markets is very weak. And I think that the negative sentiment would certainly surprise folks today.
It would. I think that point of what's priced in is so important. The hurdle is really high for U.S. equities to outperform because you've got double-digit earnings growth priced in. You talked about what we've seen for real GDP growth in Europe. That is reflected in the equity prices. And I think sometimes it can be so uncomfortable to hold an asset where it looks like the conditions are really poor. And Europe would be a great example of that. Japan, China, there's other places where it's not exciting to own that asset when you look at the backdrop, but that uglier backdrop sometimes provides you with counterintuitively downside protection because that ugly backdrop is already priced in. So we're even seeing it just so far this year. It's a short period of time, but European equities, international equities more broadly, actually outperforming the U.S. so far this year just by doing a little bit better than what's priced.
Yep. Yeah, it's interesting. You can see the hesitancy from, investors. There are good companies in Europe. There are good opportunities in the public markets. There are opportunities in the private markets for, different areas in private equity in Europe. And don't need to overextend ourselves or really reach for returns here, but having a diversified mix, we think really makes sense. And kind of the last comment on this surprise is this is not a view that we're going to see a breakup of the EU. I think that would be a very big negative surprise, and that would easily be 1,000 points down in S&P in that type of market environment. But is this the catalyst to kind of push the EU to make some real political changes in terms of looking to move to a more Republican or Republic-based system as opposed to kind of the loose confederacy that essentially is. So again, applying that policy, I'd agree this year. We'll see how it turns out.
There we go. Well, speaking of politics, I'm gonna build on for my next surprise. Build on your surprise that you absolutely nailed last year, which was single party control. And from the election results in November 2024, Republicans feel like they have a mandate and have set a goal for meaningful change in all corners of government. I think there's a lot of optimism across markets about what can happen from that. We've got a flurry of executive orders activity. We've got the involvement of Elon Musk and Doge. We've got tariffs. And so I think there's a implicit pricing in of that activity having positive benefits, but also significant policy change. An extension of the Trump tax cuts is almost a foregone conclusion. And my surprise here is just a bit of policy paralysis. I think what we've seen so far, where Trump has put through more executive orders in 10 days than any president ever has in over 100 days. Everything that's happened so far has been with essentially single branch action. It's been the executive branch signing documents to implement things, to change things, to roll back policies that were implemented by previous executive branches. We will quickly turn to policies that need to be implemented through Congress. And we talked a bit about single party control, and Republicans do have nominal single party control, but those majorities in both the House and Senate are so razor thin. Right now, with a couple open seats in the House, Republicans have a 2-seat majority. In the Senate, it's 3 plus a tiebreaker with J.D. Vance as vice president. That is not a lot of wiggle room at all. And while it is single party control, to suggest that either party is unified in any way, I think would be quite a stretch. There are very different segments of belief systems within the Republican Party as there are for Democrats. So to get unified on any kind of policy that they put forth, if it's going to be a big tax bill, you're going to have to get the more conservative, at least from a spending perspective, more conservative parts of the Republican Party to come along with that. It's not going to just be a multi-trillion-dollar spending bill. That will not be able to get through. It may mean a shortened tax cut extension. It could be 5 years, not 10 years, in order to get it through. But there will be compromises, I would expect. And there's some challenges that are coming ahead. We've got a debt ceiling extension that needs to play out in the next few months, and that will be the first point where the rubber meets the road here. But I don't think it's just smooth sailing where Republicans do whatever they want. I think they've still got to work across the aisle in some way, and even not within across the aisle within their own party. They're going to have to work together to get things done, and it will probably be more muted whatever comes through.
And essentially, when you get out of those first 100 days of the new administration, essentially midterm election season starts to pick up, and it gets more difficult to kind of find consensus and move things forward.
Yeah, and probably not the worst thing. Policy paralysis could be a negative for markets if it unwinds an expectation of impacts on growth from that policy. At the same time, policy paralysis means no changes to the deficit, and I think the base case from some of these growth initiatives would be an increase in spending, which would be worse for the deficit, which we actually just got some good news on that with the Congressional Budget Office's latest release taking $1 trillion off of the next 10 years worth of projections. So there are some positives we're seeing on the deficit that could stay in place if there is some paralysis there. Phil, let's go to your next one.
All right, this is I think I'm leaning into as much volatility as I possibly can on this one, but calling it old but shiny again, and gold outperforms Bitcoin. And kind of thinking about this, it's been a bit of an exercise over the last 12 months, thinking about the market of cryptocurrency. It's the kind of market value of crypto is almost 3.5 trillion. And we think about the size of kind of the high yield market, 1.5 trillion, or kind of, Russell 2000 small caps. And I think kind of an interesting fun stat, total value of cryptocurrency, over 3 trillion. Total value of gold held by central banks, 2.5 trillion. I think explaining that delta to someone that maybe is not fully into the world of crypto would be very hard to explain. And I think as we look at the price trajectory of cryptocurrency, it does look like a classic bubble. We've got a history of bubbles over the course of financial markets. I think probably the most kind of frequently mentioned is thinking about the tulip bubble and the Netherlands, just in terms of kind of the euphoria that built up and the price action that built up, and eventually that collapsed on itself. But I think the one thing that we kind of always learn with bubbles, they can last longer than we think they can. And so as we kind of taken a big risk on that, thinking about kind of gold relative to Bitcoin, should we see lower interest rates? Likely a catalyst for gold, especially if we see lower real rates. Greater concern around government deficits, and not just U.S. deficits, but global deficits. Likely a bit of a greater catalyst for gold. Kind of just general unease around the world. Also, typically a catalyst for gold. I think on top of that, we've seen central banks around the world express some concerns about the U.S. government using the dollar as a foreign policy tool, and starting to pivot a little bit away from dollar reserves or just building up their gold reserves. So there's a steady buy of central bank gold purchases that we're seeing. So it's a very robust market that we're seeing today. Now, sentiment and momentum can really drive markets, and this could go down as a terrible prediction, and we could see Bitcoin at 200,000 by the end of the year. But as we kind of think about, when could we see the music stop, or just the music start to slow? I think with some of the other aspects that we've talked about in some of our themes, you could really see gold, take off over this next year beyond what it's already done in the last 2 years. And maybe just for you, Tim, just thinking about how do you think about gold place in a portfolio? We do get this question from time to time from a select number of clients, and We've had thoughts and discussions on this, so just curious, share your thoughts.
You talked about a number of catalysts for gold. It takes a catalyst. It takes several catalysts, but when those catalysts are in place, gold runs for a long time. I think the return experience for gold is decade or multiple decades of nothing happening, and then a decade where it goes 10x. And this feels like, for the backdrop you described, more of an environment where gold is in the midst of a tremendous price run. We've seen it for a few years now, and I agree with your thinking here. My expectation would be gold's performance to continue being strong. Should it be held in client portfolios? Most of our clients know that we are big believers in currency hedging, in international equity allocations. And the reason for that is it's a risk management tool. We don't think you're compensated for currency returns over the long term, and you should manage that exposure by hedging some of that risk and taking that risk elsewhere if it's within your risk budget to do so. So if you have a view that currencies globally are likely to be weaker, currency hedging probably still makes sense because you don't know the timing of that, you don't know the direction. So what else can you do? Gold can make sense in that situation. I think real assets more generally can make sense in a world where inflation matters more than it has in prior decades. Having more real assets exposure, having things that perform differently than stocks and bonds can be really beneficial. And gold can be one of those things, whether it's part of a diversified real assets allocation or just a standalone allocation. I think it can make sense.
Yeah, and I think and on the other side of it, thinking about kind of crypto markets, I think the unanswerable question that I think we keep racking our brains on this is, if we see kind of a big drawdown in crypto markets, let's say you wipe $2 trillion of value, off the balance sheet, what happens? And we don't know the answer to that. Where are these pockets of money hiding that really cause some weakness in capital markets? It's hard to see. I wish we had a better answer than I don't know, but I think that's a real kind of fascinating question to think about. Is you have a big drawdown, you kind of take $2 trillion off the books. What's the reaction? And I think those are some of the things we'll be thinking about in the course of the year.
Yeah. Last surprise here, a number of our surprises involve some negative price action. And I think that's a reflection of what's priced in, whether it's that 1,000-point downward move in the S&P, some challenges in Europe, although you said maybe equities are up there, Bitcoin with a drawdown. I'm going to go with another negative market event here. And I think it's a little bit of a long shot because, as we've talked about, the market is in a bit of and the economy is in a bit of a Goldilocks moment right now. And we've talked a lot about equity pricing, how optimistic earning expectations are, valuation levels are pretty high. What's not talked about as much is pricing in credit markets. And I think we are equally optimistic there in the credit world. Oftentimes, it's credit where we see the first cracks in economic conditions and in a shift in market pricing. You look across credit right now, and I think we can all be fooled by this a little bit because we went through 15 years of zero interest rate policy, really low interest rates. And so the overall return for fixed income was so low. When we look at returns for fixed income now, expectations and yields in the 5s and 6s and 7s as you're moving out on the risk spectrum, that feels pretty good. That's really healthy compared to what we lived through for the last 15 years. Well, the spreads on that are really tight. Investment grade US spreads are well inside of 100 basis points. High yield US spreads are floating just above 2.5 right now. We're getting to all-time lows in credit markets. And that's not even getting into some of the more esoteric spaces, the asset-backed space, the CLO world. There's lots of places where there's a tremendous amount of credit activity, but at really tight spreads and looser covenants, where we could see something happen. And maybe it's not the US. Maybe it's what you talked about, Phil. Maybe it's something in the Eurozone. Maybe it's the deleveraging challenges in China. But I think when this Goldilocks moment ends, it generally ends in an ugly way. And I think that ugliness first plays out in credit markets. So that's not a prediction. That I'm putting it on here as a surprise. I don't know that that happens in 2025. I think we could have more room to run in this Goldilocks world. But if and when it does play out, I think it does happen in credit.
Yeah.
Let's. I know we've gone for a while here, Phil. Maybe just a minute or so on some of the also rans. What are some things that that didn't make the lists that could be surprises? Now, interesting. For all of the narrative and momentum around AI, we didn't have an artificial intelligence surprise. Or are there a few things there that maybe could be a surprise that didn't make it?
Yeah, because if we think back to Byron's kind of old structure of market surprises, I think he would refer to it as market surprise that had a greater than 50% chance of happening. And some of these, not sure we should even be mentioning out loud, but maybe put under, is it 5% chance or less, or type of thing, but just things that we thought about as an intellectual exercise. And so thinking about AI, DeepSeek, was that a surprise that we've already seen? Some sort of supply chain shock flowing through. Another one is AI agents have become a kind of taking maybe a bigger role in terms of performing tasks for companies. Could an AI agent commit a crime? And what does that mean? Is knowingly commit a crime or unknowingly commit a crime? Both are kind of a fascinating kind of thought exercise. So obviously AI is a fast-moving world, a lot of change coming on, but there's just a lot of thoughts around how does this manifest in markets and market impact.
Great. A couple others. I talked a little bit about politics with policy paralysis. There's a lot of focus on the deficit. And I think a lot of excitement, but skepticism about some of the projections that DOGE has put forth, like $2 trillion in savings. They are being very aggressive in their approach. And maybe a surprise is that DOGE does find $200 billion in savings. I think that's really, really unlikely when you look at the makeup of the federal budget and what they can actually make changes on, but maybe that is a surprise. I mentioned the Congressional Budget Office just last week putting out numbers that showed some deficit reduction over the next decade. Maybe that policy paralysis does play out, and maybe it's a lot harder to get things done, and any policy that comes forward is more budget neutral, and we actually see some continued deficit reduction. Wouldn't that be a good thing for the U.S. economy? Maybe that global grand bargain idea that we talked about a year ago actually plays out. That would be a big surprise given the world affairs theme that we've got in place and that we think will continue to drive the world. I think when we look at this, these surprises are predictions. They're fun. We enjoy doing them. They're not forecasts, but they are meant to push us beyond consensus thinking and give us a thought exercise of how that might play out. I think the reality is we haven't captured everything, but surprises are what happens all the time in markets. And we shouldn't be surprised by surprises. It's just what the surprise is that surprises us. That's the nature of markets, to get those surprises and for repricing to occur. And so we should prepare for this. Our portfolios should be really well diversified to be able to manage through surprises, whether it's some of these that we've laid out or others that are off the page right now. But Phil, thanks for taking the time here. I think this is a great exercise for us, and hopefully a few of these on the positive side do play out. Hopefully some of the more negative ones we stave off for another year. So thanks everyone. Hope everyone has a great 2025.
Thank you, everybody.